Hi, this is Michael Talis with the Talis team, and I'm here sitting again with Sue Baker-Dirickson, who's a mortgage broker with Guaranteed Rate Affinity. Let me share the screen for a quick second. If you look at these daily rate survey, you see that the interest rates are going down and it looks pretty positive, but it's only last 3 months. So if you will zoom out to 2-year trend, it doesn't look as optimistic as right now. So what I want to do today is to talk to Sue about current lending environment and the new loan programs that became available in response to this high interest rates. Let's start. Sue, please introduce yourself.
Hello, everyone. I'm Sue Baker-Dirickson. I'm a senior loan officer with Guaranteed Rate Affinity. As Michael said, we are mortgage brokers, so I have access to many different loan programs. I've been in the business for 36 years.
That's a good start. Amazing. Tell us about general lending environment and what are your predictions in terms of direction of interest rates?
Well, at this point, I think the biggest announcement we have is the new increased conforming loan limits that were released in December by Fannie Mae and Freddie Mac. So depending where you are physically located, the loan limits will vary. We here in the San Francisco Bay Area are in a high cost lending environment. So our loan limits are now increased on a conforming loan to $1,089,300.
Got it.
And what the increased conforming loan limits bring to the buyer is increased flexibility for debt to income ratios, lower requirements for cash reserve, and the ability to work with people with not as perfect credit.
Got it. And what about the down payment? Any specific requirements for this loan segment?
These loans require less down. So we can get people in with as little as 3% down on the standard conforming loan limits, which standard conforming right now is 726,200. But on the
Okay.
jumbos at 1,089,300, we need minimum down payment of 5%.
And in terms of PMI, oh, do they
There
have to
is
pay PMI?
PMI. They would, yes.
So
There is
any
PMI
programs
on
that
these
allow
loans.
to avoid PMI?
There are programs that allow it to be, well, it can be avoided. However, what the lender does is they build it into the interest rate.
Uh-huh.
So that is an option where you can choose to pay a higher rate of interest in exchange for not having PMI. But of course, there are pros and cons to doing that as well.
Right. And I would recommend to give Sue a call to discuss exact details of your situation. So what I
Right.
hear that right now with these conforming loans, you can go up to about 1.1 or maybe 150 purchase price with minimal down payment.
Right.
Right. And again, if you increase the down payment, then the sky is the limit, right?
Sure.
The other thing that I heard from you earlier are the buy-down programs. Please shed some light on that.
Okay. So 2-1 buy downs are new to the current marketplace. They are not new. Years ago, we did them all the time. But when interest rates were so historically low for such a long period of time,
Mhm.
there was no need for that type of a program. So as rates went up last year, it was probably about September, October that the buy down programs started becoming more prevalent. And so what this does, for example, a 2-1 buy down, what
Mhm.
it does is it reduces the interest rate for 1 year by 2%, the second year by 1%, and then the third through 30th year are at whatever standard fixed rate loans are at the time. Now there's a cost to those programs. And the way that they're set up right now, in order for us to keep under what are thresholds for buyers, what's allowable for closing costs to pay, these buy downs need to be set up so that the seller pays the cost of the buy down. There
Okay.
are also different types of buy downs. This is just one example.
And when you were saying different types, my understanding you can buy it down for 1 year, 2 years, or 3 years, right?
That's correct. That's correct. And so we just talked about 2-1. There's another one that's buy it down for 1 year, 3 times for 1 year. So the first 3 years is reduced by 1%.
Mhm.
Okay, that's another option. Or you can buy it down strictly just for 1 year.
For one
Now,
year.
the one thing to keep in mind when we are qualifying buyers for this type of a loan, they're qualifying at what the actual long-term note rate is, not
Mhm.
at what the bought down interest rate is.
Got it. So when the interest rates bump up to the whatever 30-year level, that's the interest rate you need to qualify
That's the
for.
qualifying rate, exactly.
So are there any limits on the maximum loan amount or down payment requirements for these type of loans?
So right now, we are only doing, these are temporary buy downs on conforming loan products. So
Okay,
depending where you're at to whatever the maximum limit is for your county.
got it, got it. What I hear that it's typical for the seller to pay these buy down costs. Can you
Correct.
explain why?
Okay, so when we got new regulations, when the Dodd-Frank rules went into effect, oh, probably 5, 6 years ago now, they limited how much a buyer could pay in closing costs to not exceed what was considered a high cost mortgage.
Mhm.
And so if we add the cost of the buy down into what would be typical closing costs for a buyer, we exceed the limit for a high cost mortgage. And when we exceed that threshold, that loan is no longer saleable to Fannie Mae and Freddie Mac.
Oh,
So if the contract can be set up so that the seller pays for the buy down,
mhm.
the buy down goes for the purposes of this disclosure into the seller paid column, not into the buyer paid column. And therefore, it does not force that high cost mortgage threshold to be exceeded.
Makes sense. And my understanding is that it doesn't go towards the seller credit to the buyer. So if you need credits for certain repairs, it's still possible to negotiate that credit. So it doesn't really reduce the leverage for the buyer from point of view of negotiations. Is it right?
Okay, credits are never allowed for repairs. The
Oh,
credits can be paid for as closing costs. And
okay,
yes,
right.
that would be separate from the cost of a buy down. It's just in a purchase contract, they need to be mentioned as separate items. One needs to be seller paying costs for buy down, and then one needs to be seller paying buyer's closing costs. Limits on both, whatever that dollar amount might be.
Got it. From where I sit, being a realtor, the benefit for the seller that it gives additional incentives for the buyers to work with you and look more favorably on your property. If you offer the rate buy down, it reduces cost for the buyer when they
Yes,
purchase your specific home. And that may be a benefit and competitive advantage on today's market.
right. Also, one additional benefit to keep in mind on a buy down, the buy down is a subsidy that the seller pays for upfront. So that money is put into a subsidy account. So let's just say we do a 2-1 buy down, but
Mhm.
1 year into the loan, the new buyer decides, I'm going to refinance because terms are favorable to me. There is still money sitting in that subsidy account.
Mhm.
So the money sitting in that subsidy account is used to reduce the amount of payoff on the buyer's mortgage.
Got it. So can it be a cash refund to the buyer
No,
if, okay, so it's
can't be cash.
basically,
It has to be principal reduction.
oh, okay. Well, it's basically equivalent when you think about it. It builds equity for the buyer.
That's correct. Yes.
One of the things that I hear based on the news that it is expected that the interest rates will be going down in next 1, 2, 3, 4 years, and that these high interest rate loans most likely will be refinanced at that time. Is that something that you agree with? Are these high interest rate loans supposed to be a short-term loan, or that's something that is longer term?
We're already seeing some rate improvement from where we hit the peak, which was probably in November. Interest
Mhm.
rates are down some, but the forecast is yes, within the next maybe 12 to 18 months, we are going to see lower rates. Now, we will never see the rates that we saw in 2021 ever again. So,
Never
we
say
may see,
never.
well, true, but it's not anticipated that to ever happen again. But more realistically, maybe we're going to see rates, 5.5%, maybe even into the high fours. But I think for the most part, people that are taking out mortgages right now probably would have an opportunity to refinance them at least in less than 2 years at a more favorable rate.
Makes sense. Can you tell me about the benefits of seller paying these buy down points? Because I
Sure.
understand that the benefit for the buyer is kind of obvious. It reduces their cost. It's easier for them to pay for the house at least first 1 to 3 years. And yes, we do expect that the interest rates will go down in the near future and they will be able to refinance right after that and kind of bring their housing cost under control. and with 30-year fixed loans, so they know their housing costs for as long as they own the house. So tell me about the benefits to the seller.
Okay, so we always have to, of course, do the math, but the idea being, if I'm the seller, am I better off to reduce my purchase price or to pay for a buy down for a particular client? And we can do the math. And I did one very recently for the difference of a $50,000 reduction on the purchase price, which obviously is a big reduction. The cost to do the buy down at that same time for a buyer was $15,000. So the seller netted $35,000 more. However, the huge benefit to the buyer in that scenario was for the first year, their monthly payments were $900 a month less and $600 a month less for the next year. Now, if we had reduced the purchase price by $50,000, it would not be a $900 reduction in the buyer's payments.
Got
So
it.
it's really a win-win on both sides.
Yeah, that's what I hear. So both sides benefit, and it makes a deal sweeter for both sides and easier to move forward.
Yes, right.
Another set of programs that I think you really shine in are the low down payment programs that don't require PMI.
Right.
So what are the current options? And again, requirements for down payments and the borrowing limits.
Okay, so for the most part, we can finance someone purchase a $2 million house with a minimum of 10% down. We can get as high as 2.5 with 15% down. And neither of those options would have PMI. And that's because we break the loans into two parts. So we do a first mortgage for 75 or 80%, and we do a second mortgage for the balance, whether that be 10 or 15%. That way we avoid the requirement for mortgage insurance.
Got it. And my understanding is that the second loan is a home equity loan and you can pay it off at any time.
That's correct. It is a home equity line of credit, so it works almost just like your credit card. You can pay that loan off or down anytime you want. If you want to reaccess the funds, again, you can do so for up to the first 10 years. You can, pay it off, reuse it for 10 years. After 10 years, any balance remaining, you got to pay it off in the remaining 30-year term.
Right. It's really nice because if you pay ahead on your 30-year fixed rate, it doesn't reduce your monthly payment. If you're paying off parts of your home equity line, it reduces your monthly payment, your kind of monthly expenses. So I think it's a good
immediately.
option. Yeah.
Right.
You have immediate payback. What I read in the news that the loan originations are at very low levels, historically low levels. What do you see in your business and what do you anticipate?
Definitely volume is down this year. There's no doubt over that. But the activity seems strong. Once we got through the holidays, my phone started ringing again. I was at Coldwell Banker meeting this morning and we're hearing the multiple offers again. It may be short-lived, but I definitely think there are a lot of buyers out there. We just need more inventory.
That's true. And one of the things that I hear from my contacts that they noticed that the prices were going down, especially in the fall months. They're starting to look at the market closer and saying, right now is the time to make the move. Well, if you look at Santa Clara and San Mateo counties, April of 2022 was the peak month. And since then, the prices dropped about 20%. December median home sale price in Santa Clara, San Mateo counties is about 20% lower than it was in April. So that's a huge price swing during the year. If people want to get in touch with you and get you to evaluate their specific situation, what would be the best way to contact you?
I am always available either by phone, by email, by text. And I work real estate agent hours. So we work nights and we work weekends.
24/7.
Pretty much. And, even if you've spoken to another lender, a second opinion is free. This is a huge investment. For most people, it's the biggest investment we make in our lives. And why not make sure that you've gotten the best alternatives available to you?
One question I always get that people are afraid to get pre-approved by multiple lenders because they think it will affect their credit score.
So two things to keep in mind in that regard. We now have the ability to, when someone does a pre-approval with us, they can choose if they want a soft pull on their credit or a hard pull. The hard pull pulls all three credit bureaus. So we get credit scores from all three. The soft pull only pulls one and does not hit as an inquiry onto their credit score. So that's an option that we have now that is new. We've probably only had that maybe 30 days or so. But also the other thing to be aware of when you're applying, if you decide you want to apply with multiple mortgage lenders, you want to place those applications within a 30-day window. Because the scoring models are set up in such a way that they realize you'll shop for your mortgage loan. If you do so within a 30-year window, those are scored as only one inquiry into your credit report. But if you do it outside of that window, then it would be a second one, which can have a small effect on your credit score. For most people, it's probably not a huge hit. But if we have people that are in marginal areas on their credit scores, it can really make a difference.
Right, right. And is there a limit on how many applications they can fill during this 30-day period?
There is not.
So if somebody wants to do really a research project and apply to all lenders in the area,
it's a lot of work, but they can do it.
Yeah, that's kind of that's what I'm going for. Anyways, thank you, Sue. It's really helpful, and I hope that clarifies a little bit more for my listeners and about the current lending situation and what's possible. And if you have any questions, please contact Sue or talk to me, and we'll try to answer all your questions.
Sounds great. Thank you for the opportunity, Michael.
Thank you. Thank you, Sue.
Okay, you're welcome. Bye-bye.